Hi traders! In today's video, we'll be explaining exactly what momentum trading is and then go over a simple momentum strategy. We'll take you through what momentum trading is, a powerful technical indicator to use, share a simple and powerful trading strategy with trade examples. With that being said, let's get into it. Momentum trading is a strategy where the strength of price movements is used to enter and exit positions. Price momentum is similar to the concept of momentum in physics, where mass multiplied by velocity gives the measure of likelihood that the object will continue on a given path. The term momentum was borrowed from Newton's first law of motion, where an object in motion tends to stay in motion until an external force is applied to it. Like in the law of physics, a market in motion tends to stay in motion rather than the reverse. This is the reason why a momentum indicator strategy is so powerful. Momentum is determined by trade volume and price change rates in the financial markets. So to sum up, the strategy relies on the fact that if the price is moving strongly in one direction, it will continue to stay on that path till the trend loses momentum. So you can see here that according to this principle, an instrument that goes up tends to continue going up until the end of the trend. And of course, the opposite is valid as well. When a Forex pair, stock, or commodity shows a bearish momentum, chances are high that the price will continue going down. If we look at the big picture, we can notice that trends tend to continue, and we can use momentum to determine when to buy and when to sell. There are other factors to consider as well, and we are covering them in a bit. But in general, this phenomenon occurs because instruments with positive momentum tend to have positive returns shortly, and vice versa for those with negative momentum. This is why we have found that momentum is typically the best indicator for swing trading. If you've watched the previous videos where we traded Forex in the live market condition, you would know that I am a naked chart trader, which means that the best way, in my opinion, to trade Forex is by looking at price action. This style is associated with trading without any indicators on charts, based on real-time price trends. But when it comes to momentum, it's important to use some technical indicators to get a clear picture of the direction of the trend. There are a variety of different momentum indicators, but the best one in my experience is the Williams %R indicator. If you're on Tradingview, you can add it to your chart from the indicators sections. Before we continue with the strategy, make sure to change the length or period from 14 to 40. The most important points that we need to know about this indicator are the following. Williams %R moves between 0 and -100. A reading above -20 is overbought, and a reading below -80 is oversold. An overbought or oversold reading doesn't mean the price will reverse. Overbought simply means the price is near the highs of its recent range, and oversold means the price is in the lower end of its recent range. This indicator can be used to generate trade signals when the price and the indicator move out of the overbought or oversold territory. Now let's discuss a simple momentum trading strategy that you can use to trade Forex. This is the NZD-USD chart. This is one of my favorite pairs as it's considered a carry trade currency, so investors will often buy the NZD and fund it with a lower yielding currency, such as the Japanese yen or the Swiss franc. In step 1, we need to define the trend. Are we looking at an uptrend or a downtrend? You can observe the price action and define the latest swing high or low. In general, an uptrend is usually represented by a series of higher highs followed by higher lows. You can also use the zigzag indicator to make life easier. We can notice here a clear uptrend as price is forming a series of higher highs. Now it's time to move on to the second step. Here I want you to look for bold candlesticks that close near the higher end of the candlestick. In another word, we want to locate some clear bullish engulfing pattern with a long body. This will serve as a second confirmation, which would increase the likelihood that we are dealing with a high probability trading setup. We can see that we have an ideal representation of what we're looking for. The upside price movement is preceded by big bullish candlesticks, This confirms the momentum behind the trend. With that being said, it's time to focus on the Williams %R. This is probably one of the best Forex momentum indicators. In our example, we'll use it as a third confirmation and an entry signal. So in step 3, we need to wait for the Williams %R indicator to get to the oversold level, which is in general below the value of -80. Then rallies above the -50 level before buying. The best part about this strategy is the fact that it gives us enough time to check out the fundamentals if we are looking for another confirmation. We can notice that the Williams %R value is above -15, which means that the pair is believed to be trading at a level above its intrinsic or fair value. So let's monitor the chart and wait for the price to drop to -80. We can notice that the price went through a consolidation phase and the Williams %R value dropped to -80. At this stage, we can tell that the pair is traded at a lower price and has the potential for a price bounce. In general, the oversold condition can last for a long time, and therefore being oversold doesn't mean a price rally will come soon or at all. In our example, we're going to wait for the Williams %R to rally to -50. Once the value gets to that level, we immediately enter a long trade. But how to position the stop loss and take profit? There are plenty of ways to position the stop loss, but according to the strategy, we should place it a few pips below the latest higher low. Alternatively, as we progress, you can also trail your stop loss below each most recent higher low. This method will allow you to lock in the potential profits in case of a sudden market reversal and give the price enough room to fluctuate before heading towards our take profit level. But what about the take profit? As this is a price action strategy, you can opt for a 1 to 1.3 at the beginning and keep on changing it until the price breaks below the previous higher low. This will probably be the end of the uptrend. You can notice this strategy would have made us around 50 pips profit. Now, let's look at an example of a short trade. The rules are pretty much the same. This is the Euro-USD 1-hour chart. We can notice the beginning of a downtrend featured with a series of lower highs. The price has formed some bold bearish candles along the way. Remember that we're looking at a 1-hour chart, which means that every single price action is meaningful and reflects the actual status of the market. The candles here have a very short or inexistent tail, which is regarded as a strong signal of conviction by sellers. Now let's look at the Williams %R reading. We can see that we are in an oversold area, so it's better to wait for a few more hours. The reversal here has pushed the Williams %R value from an oversold to an overbought level. The key value here is -25. The price continued its downtrend and brought the Williams %R value to -50, which is our signal to go short. The stop loss should be put a few pips above the latest lower high, and we should remain in the market until the end of the downtrend, which is usually when the price records a new higher high. This trade alone has made 140 pips profit. We can create a trading indicator for this strategy. Let us know in the comments section if you are interested. And don't forget the thumbs up if you want to see us backtesting this strategy 100 times. Thanks for watching, and don't forget to check out the other videos on this channel and subscribe so you won't miss any of the coming videos. Happy trading!